Hello everybody, this is Toni Turner and welcome to the market now as of about 10:30 a.m. Eastern on Friday, January 22nd. U.S. stocks opened higher today as a cold wave across the United States and Europe helped oil prices surge for a second day. The European Central Bank and the Bank of Japan are reportedly set to provide more policy stimulus in the very near future. That's helping the markets also. European Central Bank President Mario Draghi's remarks on Thursday indicated that the bank could ease its monetary policy in March. Reports in the Japanese press suggested that the BOJ, the Bank of Japan, could do something as early as next week. And again, these reports are helping the market, along with the fact that oil is up today about 5%. Investors are also relieved that the S&P 500 held up at its October 2014 low at about 1871 earlier this week. So in the coming weeks, since the market's fallen so far and then rebounded, we will see if this rally has legs. Let's look at three charts that could help us determine that. Our first chart for today, yes, it looks a little confusing, but it isn't, is the S&P 500 spider, symbol SPY. As you all know, this is the tracking stock or exchange-traded fund that closely follows our S&P 500 index. Now, we know that the SPY opened a gap way down here on January 2nd, opened at $200.49 after closing the year at 203.87. So right away we got off to a very kind of nebulous negative start here. Since then, the market has dipped down. The SPY has dipped down to making a low on this past week on Wednesday, a low of about 181. When we have these kinds of moves, and we can see this line all the way down, obviously the SPY is trading below the red line, the 20-day moving average, the green line, the 50-day, and the 200-day line, these are the black line, which are all moving averages. We know that we're trading at quite a discount to that, and again, dipping down to 181. Sometimes a smart thing to do is to plot Fibonacci retracement lines on your chart. I've done so today. We can see that as I captured this chart again about 10:30 Eastern, the SPY is trading at $190.06. It's gapped up pretty dramatically this morning, and we see that a lot of times when we have very big moves down that become oversold. So I'm looking at a recent high on December 29th, right back here. This recent high was at $207.79. I've stretched my fib lines down to the zero line down here at about $181. If we do that, we can see that what the fib lines tell us is that since it's low, relative low on Wednesday, and yes, thank goodness, it held these August and October lows. Since then, the SPY has rallied back up pretty dramatically here. We've got a short squeeze going on, and as we say, some buy the dippers. Although volume has not been too strong, and that is, yes, indeed, a warning to us. What these Fibonacci lines represent are potential resistance lines, or where people will start selling. All of these scared and mad people who had stocks back here and who are fearful now and who are saying, hey, my stock went up a little bit, I'm going to sell it and get out before this market falls again. That's the kind of thinking, obviously, that goes on in these kinds of moves. So what we see here, the 38.2% line would take us to a next resistance level of about 191 on the SPY. The 50% line would take us up to just about the top of 194 into 195 will be our next potential resistance when and if the SPY moves back up to these levels. And our 61.8% line comes in right at 197.98, where we can see prior resistance and even support before. So these numbers are going to be pretty, these levels will be important to us as traders and investors. Also, let's remember here, and we're going to talk about this in another chart. Let's remember the definition of an uptrend. The definition of an uptrend is higher lows and higher highs. So indeed, to prove itself now, the SPY, after coming down in this pretty strong short-term downtrend, it's going to need to make a higher high above 181, or a higher low above 181, and a higher high. So it's moved back up to 190 here. It's going to, again, have to keep moving up through these lines of resistance and over 195 to prove to us that it has legs. So I wouldn't load the boat quite yet, and if you do start buying stocks, it's okay. Please do put in protective stops with your broker in case we see more volatility, which I really suspect we will next week. Okay, our next chart today is the United States Oil Fund, the USO. The price of oil has become very, very important to traders and investors. And it's something we want to watch as the market now seems to be correlated with the price of West Texas Intermediate. United States Oil Fund is an exchange-traded security designed to track the daily price movements of West Texas Intermediate. We call it WTI, light sweet crude oil that we sell here in the United States. Now, please know that the USO does not tell you the price of oil per barrel. It, again, is following an index. Excuse me, but we can use it to show us whether oil prices are going up or down, West Texas crude are going up or down. Now, as you can see here, we have quite a fall. Our recent low here was at $7.92 on Wednesday. You don't see it on this chart, but we can contrast that to a high of 39 in June of 2014. So, oil has taken quite a beating over the last year and a half. Now, however, we look at all this volume coming in right here. We look at the fact that once again oil is oversold. It has been quite a bit. We look at this rally here and we wonder if it's the bottom in oil prices right now. And please keep in mind, we do not know. This volume here tells us a lot of people are interested. There's buyers coming in. Of course, there are also sellers as it was coming down. And we can watch the USO on a daily basis or weekly, whatever you do, and say that at the moment anyway, the SPY, S&P500, the indexes, and oil prices are correlated as to direction. So let's just say that if the USO moves up, we'll make it simple. If the USO moves up, the market will probably move up. If the USO moves down, the market will probably follow it. And we can probably use that for the next week or so until this correlation is broken. So keep an eye on the USO. As I tracked it today, as I captured this chart, it was trading at $9.08. It gapped up. The S&P 500 and almost everything else gapped up. Let's see, and let's remember again the definition of an uptrend. Higher lows and higher highs. Let's see if this rally has legs. If it does, that's great. Just so, we're going to look at a chart we looked at a couple of weeks ago because I know everybody, I know myself included, is interested in finding the bottom in oil. Thus, we know oil companies will rally and we can hopefully get in at the bottom. Let's, though, be careful with this. This, again, is a daily chart of the Select Sector Spider Energy ETF, symbol XLE. We can see that it's come down pretty dramatically in a downtrend. Recently on Wednesday came down to about $50. Since then, it's moved higher with the price of oil moving up. When I captured it today, it had gapped up dramatically with the market. Is now trading at $55.65. Please remember the definition of a downtrend: lower highs and lower lows. So until, I know a lot of people want to get into oil right now, oil companies, myself included. Please remember the definition is of an uptrend now is higher lows than the last low at 50, and hopefully higher highs. But hope is not a strategy here. The XLE has resistance where its 20-day moving average is coming down. We'll have to see if the XLE can move through that resistance, its price resistance as well as moving average resistance. Again, we also need it when it pulls back to make and to try to retest back down to 50. We want it to make an equal or higher low. Then we have a little better reassurance that there are indeed buyers down here who will potentially buy if price moves back down to that area. That's what we want to sleep a little better at nights. We can see the 14-day RSI here is making a little bit of a higher low, a bullish divergence here. We'll have to see if the RSI can continue to move higher as well. So if you do get into oil companies here or the XLE, please put in a hard stop with your broker. I think we could still see some surprises to come in the markets and in oil. Don't know what exactly, but I'm pretty sure there's more to come in the next week or two. Okay. Now we'll go on to next week's economic reports. But first, please join us this coming Monday online from 4:30 to 6 p.m. Eastern for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who can't attend our live session, no problem. We give the recording of our session that is available to all of our members a few minutes after the session ends. And now for the coming week's economic reports. On Monday, we don't have much going on. On Tuesday, we have the Case-Shiller Real Estate Index. Wednesday, we have new home sales, crude inventories, and the FOMC rate decision. That will be important. Thursday, we have durable orders, weekly jobless claims, and pending home sales. Friday, we have the GDP, Chicago PMI, and Michigan sentiment, the final report. Please also remember we are smack dab in the middle of earnings season, and the large cap companies will have the power to pull the major indexes up and down depending on their results and the market's opinion of those earnings results. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.